Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't have to, and today we are looking at 3 stocks that could soar in the second half of 2022 and beyond, because these stocks are also going to be phenomenal long-term investments. Now, the majority of these stocks are going to be stocks that already should be in your portfolios, but we're going to discuss what analysts think of these companies, and why I personally am dollar cost averaging into these companies. So the first one, of course, is going to be Apple, ticker symbol AAPL. And this is a gigantic technology company that is the most known for their iPhones and their iOS operating system. Apple also has fantastic brand loyalty and a very impressive ecosystem among their various devices. And the CEO, who is Tim Cook, said that their active devices currently number around 1.8 billion, which is actually up 9% from the year prior. This company is also extremely profitable, and they have a market capitalization close to nearly $3 trillion, trillion with a T, which is a very large number that is hard to grasp. The current AAPL stock price trades for around $166 right now. The low-end analyst price target for the stock is $160. The average price consensus for this company is $192 for the next 12 months, and the bullish positive price prediction for this company is $215 per share. Right now, around 45 analysts are covering the stock, with 38 of these analysts saying to buy the stock, 7 analysts saying to hold the company, while none of these analysts say to sell the stock or that the company is going to underperform. Now, ideally, you would want to snag Apple and have an average cost for Apple stock at around $130. So if you are below this, feel free to average up your cost for Apple, because it's a fantastic long-term buying opportunity. Apple has amazing growth, and their growth does not look like it's stopping or even slowing down anytime soon. For their fiscal quarter that ended on December 25th of 2021, they had revenues that reached around $123.9 billion, which is an all-time quarterly high, which is up around 11% from just a year ago. So Apple has fantastic revenues, generates a large amount of profits, and they are still increasing their operating profit, which grew at a rate of around 24% to $41.5 billion. As you can see right here, we have a graph of Apple stock starting back from March of 2017 all the way until present day, and you can see this phenomenal and insanely impressive positive growth rate, which could make you very wealthy as an investor, especially if you decided to invest right here. Now, over the next 5 to 6 years, the graph can continuously improve at a compounding annual growth rate to where right now we could be sitting at around right here, and then it still has fantastic upside opportunity and potential for the years to come. So I don't want to hear, oh, well, I don't want to invest at the top. This company, we don't really know about the future projections. And although that is true, if you hold companies like this for the long term, it's honestly not going to matter that much. Unsurprisingly, most of Apple's sales, around 58% of them, came from their iPhones. And their iPhone 13 has helped them tremendously because it propelled their sales upwards by a rate of around 9%. So Apple is a clear keeper based on the strong fundamentals of the company, the amazing compounding annual growth rate of the overall stock price. Analysts love the company, and they have an extremely loyal customer base. The next stock I want to talk about is Walmart, ticker symbol WMT. The current Walmart stock price currently trades for around $136 per share, while the low-end analyst price target for the next 12 months is also $136. The average price consensus among analysts is $165 for the next 12 months, while the bullish positive price prediction is $185. Walmart is a market leader, and they are one of the largest retailers on the face of the entire planet. And although they have experienced some supply chain difficulties, Walmart continues to do extremely well in the overall market. Right now, around 42 analysts cover the company. 33 of these analysts say to buy the stock, 9 of the analysts say to hold the company, while none of them said to sell the company or that the company is going to underperform. In a perfect world, we would want to get Walmart below $136, but according to Morningstar analysts, the average fair value price for Walmart stock is $145, and because it's trading below that amount right now at $136, Walmart is a good buying opportunity. And the reason why the current stock price is trading below their fair value of $145 is due to various variants, high inflation, global political tensions abroad, various FUD, which is fear, uncertainty, and doubt in the overall stock market, and this has caused various good stocks to actually trade for cheaper than what they're actually worth. If we look at Walmart's chart, we can also see a fantastic compounding annual growth rate that is extremely impressive. And unlike Apple, we are not trading at all-time highs. We actually have a good buffer of safety right here, which just makes Walmart a better investment in my personal opinion. Now, I do personally own a lot of Apple and Walmart stock in my personal portfolio, so even though inflation is accelerating, this actually just makes shoppers want to find better bargains, and at what better place would you find fantastic deals and cheap prices other than Walmart? Walmart's last fiscal quarter, which ended on January 31st, saw that the store sales have increased by around 5.6%, and it continues to grow its overall profits. Their adjusted operating income increased by around 6.2% to $6 billion, which is absolutely astounding. Their management actually projects that the sales growth for their overall revenues will grow at a rate of around 4%, while their operating income will actually grow by a figure more than that. Now, the reason why their growth rate is actually a lot lower than other companies right now is because Walmart is so big, they're trying to fight against the law of large numbers, which means that these potential increases, even though they represent hundreds of millions of dollars, the increase on a percentage basis is rather low. Because once you're obtaining billions and billions of dollars worth of revenues, it's really hard to grow that number consistently by large margins. For instance, the company has generated over $570 billion worth of annual revenue. So it's not like Walmart can 2x that, bringing in over $1 trillion worth of revenue each year, and investors should not anticipate that from this company. This is a very stable, long-term, fantastic buying opportunity in Walmart stock right now that will not only provide consistent long-term gains and stock price appreciation, but it's also a fantastic blue chip company that can lower your overall risk for your overall portfolios. So it lowers your risk of any losses, and it also gives you stability in your overall portfolio, which is amazing news, and that's why I personally own this company. And even though Walmart is bringing in hundreds of billions of dollars worth of revenue, the company continues to improve itself. For instance, the company spent around $13 billion last year on increasing and optimizing various categories such as supply chain, automation, and customer-facing initiatives, and these endeavors have gone so well that their management has actually opted to invest another $17 billion in these same areas in the coming year. So this is overall fantastic news, not only for Walmart in general or for shareholders, but also for the overall company in the future, because they want to stay competitive. Walmart has also received a lot of competition from Amazon, which is another fantastic stock that I love to dollar cost average into, but surprisingly, Walmart has been able to hold their own against Amazon and even gain market share, mainly from their competitive grocery business. And this is working synergistically and in tandem with them dominating the retail market. So they are really holding their own against e-commerce businesses like Amazon. Now, I do want to talk about Amazon because I love Amazon as an overall company. And the last company we're going to talk about is actually Walt Disney, but first I want to talk about Amazon. Amazon is an e-commerce business, and the AMZN stock currently trades at around $3,041 per share. The low-end price target for the stock over the next 12 months is $3,333. The average analyst price prediction over the next 12 months is $4,100, while the high-end most positive bullish prediction for the company is $5,000. And to me, buying this company below their fair value price according to Morningstar of $4,100 is an absolute steal, which is why dollar cost averaging into this stock now is a fantastic opportunity for very long-term safe investors. Currently, around 57 analysts cover this stock, with 56 of these 57 analysts saying to buy the company, with one of these analysts saying that the company is a hold, while none of the analysts say that the company is going to underperform the overall stock market, and clearly none of them say to sell the company. And these should be staples in your portfolios. If you do not own these companies, then you are missing out on fantastic safe investing opportunities to build wealth over the long term. But lastly, I want to talk about Walt Disney, ticker symbol DIS. And Walt Disney has extremely strong content. They also have their fantastic Disney Plus streaming service, which is relatively new, where their number of paid subscribers has increased from around $73.7 million to $118.1 million within the last year, which is absolutely phenomenal. Disney is literally an empire, because they offer streaming services, movies, TV shows, networking channels, merchandise, toys, and a plethora of other things. I also want to highlight in the recent quarter, which ended on January 1st, their revenue grew by around 34%. Now, this is slightly misleading because the revenues fell drastically during the lockdowns, so now they are clearly experiencing that slingshot effect by growing their revenues by around 34%, which is very impressive for a company the size of Disney, but nonetheless, this revenue growth does say that the company is recovering very adequately. Currently, the DIS stock trades for around $148 per share. The low-end price target for the stock is $132. The average price prediction for the overall company over the span of the next 12 months is $191, and the most bullish positive price prediction among analysts is $229. Now, according to their fair value, anything below $170 is going to be a fantastic buying opportunity for the DIS stock, according to Morningstar. However, I do want to point out that their PE ratio, or their price to earnings multiple, is very high, sitting at around 86 according to Robinhood. But what do analysts think about this particular company? Well, right now around 33 analysts cover the stock, with 26 of these analysts saying that the stock is a phenomenal buying opportunity, while 7 of these analysts say to hold the stock. And of course, none of these analysts said to sell the stock, and none of them said that the company was going to underperform the overall stock market. Now, unlike the other 3 stocks that I highlighted, Disney has not had the same stock price appreciation as the other companies. However, this is still a very good positive slope, and as you can see, the stock has pulled back as of late due to their earnings reports, which is a fantastic buying opportunity because it's currently trading for around the same price as it was back in 2019. So it's like you invested all the way back into 2019 in this company without any opportunity cost. And for that reason, that is why I have actually bought a little bit of DIS stock. However, I am not nearly as invested into Disney as I am in the other 3 companies that I previously mentioned. But let me talk more about this company because this company could be a fantastic addition to your personal portfolio. First off, I like what management is doing because their management knows how to leverage their movies, their television shows, their theme parks, their merchandise, their streaming services, and a plethora of other offerings that Disney gives its consumers. The company was founded nearly 100 years ago, and it's still standing very firm right now, and it has fantastic forward growth momentum and a good positive growth trajectory, which makes this a staple in the portfolios of long-term growth investors that really want to build wealth. Disney stock can certainly reward shareholders and investors. However, you are going to have to compare Disney with the other stocks on this list. Any blue chip stocks are going to be fantastic staples for any foundationally solid portfolio, and again, if you are not invested into any of these 4 stocks, you should really do your research into these companies. But I would love to hear your thoughts down below in the comments. Comment down below some of your favorite blue chip stocks. Like this video right now for more stock videos like this one. Subscribe if you are new, and I will see you in the next YT video.